In the next 14 hours, silver's market cap swung by nearly $2 trillion, $500 billion added, then $1 trillion wiped out. And then it surged again. This is not normal market behavior. This is a signal. The US dollar just collapsed to its lowest level since 2022. Trump's tariff war with Canada and China is escalating. Russia and Ukraine, no resolution in sight. And Venezuela's oil is now under American control. All of these forces are converging in one single month, February 2026. What happens next could either make you or break you. But before I reveal what's coming, there's something you need to understand first. Welcome back to John Analyst. Now, if you've been with us for a while, you already know we don't do hype here. We do analysis, we do facts, we do preparation. But if you're new to this channel, let me ask you something respectfully. You've worked hard your entire life, built something meaningful, so why leave your financial future to chance? Hit that subscribe button right now. Join a community of serious investors who prepare before the storm hits. And while you're at it, drop a comment below. Tell me, where are you watching from today? USA, Canada, UK, Pakistan, India? I genuinely want to know who's in this room with me. Now, let's get into what February 2026 has in store. On a seemingly ordinary trading day in late January 2026, the global silver market did something extraordinary, something that veteran traders had never witnessed before in their entire careers. Within a span of just 14 hours, silver's total market capitalization swung by nearly $2 trillion. To put that into perspective, that is larger than the entire GDP of Australia. Moved in less than a single day. Between 9 onward AM Eastern and 1 GAR PM Eastern, silver added $500 billion in market value. Investors around the world watched in disbelief as prices surged relentlessly higher. Buy orders flooded in from institutional desks across New York, London, and Shanghai. It appeared as though the precious metal was entering a new phase of price discovery. But then, everything changed. Between 1 p.m. Eastern and 4:30 p.m. Eastern, silver lost nearly $1 trillion in market capitalization. The same traders who had celebrated just hours earlier now sat frozen in front of their screens. Red candles dominated the charts. Panic spread through trading floors. Retail investors rushed to sell their positions, fearing a complete collapse. Financial media outlets scrambled to explain what was happening. Headlines screamed about a silver crash. Some analysts declared the bull market was officially over. But here is what most observers failed to understand. This was not a crash. This was not even a correction in the traditional sense. This was a shakeout. A deliberate, calculated, and highly coordinated redistribution of assets from weak hands to strong hands. Because within the following 5 hours after that massive decline, silver added back $500 billion in market capitalization. The price recovered almost as quickly as it had fallen, and by the end of that 14-hour window, silver closed higher than where it had started the day. Now, the average investor watching this unfold would simply call it volatility. They would shrug their shoulders and move on. But serious analysts, those who study market structure and institutional behavior, they recognize this pattern immediately. This type of violent price action, this whipsaw movement designed to trigger stop losses and shake out retail positions, it only occurs when major players are accumulating. When institutions want to acquire large quantities of an asset without driving the price too high, they create chaos, they engineer fear, they manufacture headlines about crashes and collapses. And while the average investor panics and sells at the bottom, the smart money quietly accumulates at discounted prices. This is not conspiracy theory. This is market mechanics, documented and repeated across every major asset class throughout financial history. And silver's $2 trillion swing in January 2026 fits this pattern precisely. But here's where the analysis becomes truly critical. This type of accumulation phase, this level of institutional activity, it does not happen randomly. It happens before major market moves. It happens when large players possess information or expectations about future events that the general public does not yet fully appreciate. And what event is approaching rapidly on the calendar? February 2026, a month that represents the convergence of multiple economic and geopolitical forces, forces that have the potential to reshape the precious metals landscape entirely. The Trump administration's tariff policies are reaching a critical inflection point. The US dollar is showing structural weakness not seen in years. Geopolitical tensions between major world powers remain unresolved, and central banks around the globe continue accumulating gold at record pace. All of these factors, all of these forces, they are scheduled to collide in February 2026. The silver market, through its extraordinary volatility, is sending a message that most investors are too distracted or too fearful to decode. But for those who understand market structure, For those who recognize institutional accumulation patterns when they appear, the message is unmistakably clear. Something significant is approaching. The 14-hour tremor was not an anomaly. It was a preview, a rehearsal for what February 2026 is preparing to deliver. The only question remaining is whether investors will recognize the signal or whether they will once again be caught unprepared, watching from the sidelines as history unfolds without them. The smart money has already made its decision. The accumulation is already underway, and the clock is now ticking. There's an old saying among currency traders: when the dollar sneezes, the world catches a cold. But what happens when the dollar does not simply sneeze? What happens when it collapses to its knees? In January 2026, the US dollar index fell to a level not seen since 2022. And for those who understand monetary history, this was not just another data point on a chart. This was a warning siren, blaring across every trading desk on the planet. The world's reserve currency, the foundation upon which global trade has been built for decades, is showing cracks that can no longer be ignored. Now, most financial commentators dismissed this decline as temporary. They called it a minor correction. They assured their audiences that the dollar would recover, as it always has. But serious analysts, those who study the underlying mechanics of currency systems, they saw something far more troubling. They saw structural decay, the kind of decay that does not reverse with a single policy adjustment, the kind of decay that accelerates until confidence finally breaks. And here is what makes this particular moment in history so dangerous. The very policies being implemented by the United States government are designed to weaken the dollar further. This is not accidental. This is intentional. The Trump administration has announced plans for massive fiscal stimulus, tariff dividends, direct cash payments to American citizens funded by import taxes, are expected to inject thousands of dollars into every household. On the surface, this sounds like economic relief, but beneath the surface, this is pure monetary expansion. More dollars chasing the same amount of goods. The textbook definition of inflation, and that is only the beginning. The administration has also signaled its intention to pressure the Federal Reserve, to lower interest rates dramatically, potentially down to 1%. Now, for younger investors who have only known the post-2008 era of easy money, this might seem normal. But for seasoned economists, for those who remember the consequences of aggressive rate cuts, this is a recipe for currency destruction. When interest rates fall to near zero, the incentive to hold dollars evaporates. International investors begin seeking alternatives. Capital flows out of dollar-denominated assets and into hard assets, assets like gold, assets like silver. This is not theory. This is precisely what happened during the 2008 financial crisis. This is precisely what happened during the COVID-19 monetary expansion. And this is precisely what is beginning to happen right now, in early 2026. The historical correlation between dollar weakness and precious metal strength is not subtle. It is direct, measurable, and remarkably consistent. During every major dollar decline over the past 50 years, gold and silver have experienced significant appreciation every single time, without exception. And the current trajectory suggests this pattern is about to repeat with even greater intensity, because the scale of monetary expansion being discussed today dwarfs anything seen in previous cycles. Trillions of dollars in new stimulus, interest rates slashed to levels that punish savers, a national debt approaching levels that mathematically cannot be serviced without further money printing. These are not partisan talking points. These are structural realities, acknowledged by economists across the political spectrum. The dollar is not experiencing a temporary setback. The dollar is experiencing a slow-motion devaluation, engineered by policy choices that prioritize short-term stimulus over long-term stability, and for investors holding their wealth in dollar-denominated assets. The implications are severe. Every day that passes, every new stimulus program announced, every interest rate cut implemented, erodes the purchasing power of those holdings. Meanwhile, gold and silver, assets with no counterparty risk, assets that cannot be printed into oblivion, they absorb that fleeing capital. They become the refuge for those who recognize what is happening. February 2026 represents a critical inflection point in this process. The policies are accelerating. The dollar's decline is accelerating. And the window for repositioning is narrowing rapidly. Those who understand monetary history will act accordingly. Those who do not will learn an expensive lesson, paid in depreciated dollars. In the world of geopolitics, there are no coincidences, only calculated moves and counter moves. And right now, in early 2026, the global chessboard is set for a confrontation that will send shockwaves through every financial market on Earth. The players are positioned: the United States on one side, Canada, China, and the European Union on the other. And caught in the middle of this high-stakes game, gold and silver, the ultimate beneficiaries of chaos. Now, to understand what is about to unfold in February 2026, one must first understand the playbook, because this is not the first time these moves have been made. This is not even the fifth time. This is the 11th iteration of the exact same sequence. And those who have studied the pattern know precisely what comes next. It begins with a threat, a bold, aggressive, deliberately provocative tariff announcement, designed not necessarily to be implemented, but to create leverage, to force negotiation, to remind trading partners who holds the upper hand. President Trump has mastered this technique. Every major tariff announcement since his return to office has followed identical choreography. Sunday evening, just before Asian markets open, the threat is issued. Monday morning, global markets react with panic. Gold surges. Silver explodes higher. Currencies fluctuate wildly. Headlines dominate every financial news network. And then, after days or sometimes weeks of tension, negotiations begin. Concessions are made. A resolution is announced. Markets stabilize. This pattern has repeated almost without variation 10 times in the past 18 months. And February 2026 appears destined to be iteration number 11. But this time, the stakes are higher, because Canada is no longer playing by the old rules. Prime Minister Mark Carney, a former central banker who understands monetary warfare better than most politicians, has drawn a line in the sand. At the World Economic Forum in Davos, he made a declaration that stunned American officials. Canada would diversify its trade relationships. Canada would reduce its dependence on the United States. Canada would seek new partnerships with Europe, with Asia, with anyone willing to trade on fair terms. This was not diplomatic posturing. This was a strategic pivot, years in the making, and President Trump's response was predictable. When challenged, he does not retreat, he escalates. The rhetoric intensified, new tariff threats emerged, and the volatility engine roared back to life. Meanwhile, on the other side of the Pacific, China watches carefully. The 100% tariff threat hanging over Chinese goods has not been forgotten in Beijing. Chinese officials have made clear any aggressive action will be met with proportional response. Tit for tat, tariff for tariff. A trade war that neither side can truly win, but both sides refuse to lose. And here is what most casual observers fail to grasp. The period between threat and resolution, that window of maximum uncertainty, is when precious metals experience their most explosive moves, not after the deal is signed, not when stability returns, but during the chaos itself. This is when institutional capital floods into safe haven assets. This is when central banks accelerate their gold purchases. This is when silver, with its smaller market cap and higher volatility, delivers returns that dwarf almost every other asset class. February 2026 sits directly in the center of this volatility window. The Canada situation remains unresolved. The China tensions continue escalating. European tariffs loom on the horizon, and every single one of these pressure points feeds directly into precious metals demand. The playbook is clear. The pattern is established. The only variable is whether investors position themselves before the volatility peaks or after the opportunity has passed. 11 times, this sequence has rewarded those who understood the game. 11 times, those who panicked or hesitated watched profits slip through their fingers. February 2026 will be no different. The chessboard is set, the pieces are moving, and the clock is counting down. There is a question that haunts every serious investor in times of uncertainty. How long can chaos sustain itself? The answer, as history repeatedly demonstrates, is far longer than most people expect. And in early 2026, the world faces not one, not two, but three unresolved conflicts, each feeding into the other, each amplifying global uncertainty, each driving capital relentlessly toward the oldest safe havens known to mankind, gold and silver. Let us begin with the conflict that refuses to end. Russia and Ukraine. Since February 2022, this war has defied every prediction of swift resolution. Presidents have promised peace, diplomats have shuttled between capitals, ceasefire proposals have been drafted and discarded. And yet, the fighting continues. President Trump, upon returning to office, declared confidently that the war would end within months. He spoke of back-channel negotiations. He hinted at breakthrough agreements. He assured the world that his deal-making prowess would succeed where others had failed. But the betting markets, those cold and dispassionate predictors of reality, tell a different story. Polymarket assigns just 16% probability to a peace deal in early 2026. Manifold Markets puts the odds at 41% for the entire year. Even by December 2026, the consensus probability barely reaches 44%, less than a coin flip. And every time, without exception, that President Trump has announced progress toward peace. Russia has responded by intensifying its military operations. More troops deployed, more territory contested, more uncertainty injected into global markets. This is not pessimism. This is pattern recognition. And the pattern clearly indicates this conflict will not resolve quickly. For precious metals investors, this means sustained demand. Because during times of war, during times of geopolitical fracture, capital does not sit idle in paper currencies. It migrates toward assets that have preserved wealth for thousands of years, assets that cannot be frozen by sanctions, assets that cannot be devalued by central bank policy, assets that exist outside the control of any single government. Gold and silver are those assets. And as long as the Russia-Ukraine conflict persists, the fundamental case for precious metals only strengthens. But this is not the only unresolved situation demanding attention. Thousands of miles away, in the Caribbean, Venezuela has become the center of a different kind of conflict, an oil conflict. The United States government has taken extraordinary measures, removing a sitting president from power, and now prosecuting him in New York City. Venezuelan oil, once flowing freely to China and Iran through unofficial channels, is now being redirected. A new general license issued by Washington establishes a 3-step process, where all Venezuelan oil must first pass through American hands before reaching international markets. No more ghost fleets. No more shadow trades. Complete American control over one of the largest oil reserves on the planet. Now, on the surface, this might appear to be simply an energy policy, but beneath the surface, this is a direct challenge to China. Beijing had substantial agreements with Venezuela. Massive quantities of oil were flowing eastward. Those flows have now been disrupted. And China, already engaged in a tariff confrontation with Washington, now faces another pressure point. Another source of tension. Another reason to accelerate its own accumulation of hard assets. It is no coincidence that Chinese gold imports have reached record levels. It is no coincidence that Shanghai silver premiums have diverged dramatically from Western prices. China is preparing. China is accumulating. China understands what February 2026 represents. The convergence of multiple crises. Dollar weakness accelerating, tariff wars escalating, military conflicts persisting, oil supplies being weaponized, all roads lead to precious metals. Expert forecasts now project gold reaching $6,000 per ounce under current trajectories. Silver targets of $39, and potentially far beyond, are being discussed openly. These are not fantasy numbers. These are mathematical projections based on capital flows, supply constraints, and sustained global uncertainty. February 2026 is not just another month on the calendar. It is the convergence point, the moment when all of these forces collide simultaneously. Those who have positioned themselves in gold and silver will be prepared for whatever emerges from that collision. Those who have not may find themselves watching from the sidelines. Once again, the warning has been delivered. The signals are clear. The only remaining question is whether you will act before February arrives.